Folks, thank you for being a part of the channel, one rental at a time. On Sundays, we have the pleasure of speaking with the Mr. Dan Bird. We look at last week, next week, but also we have a video number 2 where he picks a topic he wants to share with you. Today, we're going to do a sector review with a specific deep dive on big tech. We're also going to talk about something called Darvis boxes. Lots of great stuff coming. Dan, thank you very much for being here.
You bet. My pleasure.
Awesome.
Yes, sector review is something we have done before here, but we haven't done it in a while. And it's something that I like to do, my normal research each weekend. I like to look at the sectors and see how they're performing versus the S&P.
Yep.
So we'll go through each of those, and I'm going to point out some very interesting changes that are occurring. Some things that are happening with the market under the covers that look like things are beginning to change a little bit.
Okay.
And then we'll look at some of the big tech names and see what they look like.
Awesome.
Let me share my screen here. And for those who are not getting my newsletter but would like to, this is something I do every weekend. There's no charge for it. If you're interested, just send me a note to breakpointtrading@gmail.com, and I'll send you last week's newsletter and I'll add you to the list. And if you want to get taken off, just send me a note and I'll take you off as well. So let's start with this one that we haven't really looked at lately. This is the rotation, sector rotation.
I remember this, yes.
Chart. Just as a review, this kind of gave us an advance warning that the market was going to go down this year, because in December, the market was hitting higher highs. But at the same time, technology and growth sectors were hitting lower lows. The growth in technology were going down at the same time the market was going up, which means all of the big institutions were rotating out of growth and into value, becoming much more defensive. And as the market continued down throughout the year, that continued down as well. Until in June, it started to reverse a little bit, but then we ended up making another bottom. So we were hoping that the June bottom was the bottom, but now maybe this is the bottom, October. So this green line here is the lowest close so far this year. And what happened with these sectors, these growth sectors, this is discretionary versus staples, this first one. The next one is the Qs versus the SPY, so NASDAQ versus the S&P. And then we have the technology sector versus the S&P. And then this one is the Russell growth versus value down here. And the last one is the NASDAQ advancers and decliners, which is pretty interesting. So what happened in June is the market made a new low, but these started to climb higher, implying that the big institutions were starting to rotate back into growth areas and technology. But then the market went down and made a new low. So what happened to those? Well, they went sideways for a while, but then they started going down below their previous low, which is what this blue line is right here. They actually started to go down below even further. Now, if the market had continued to go down, that would be very concerning for big institutions to continue to rotate into value areas as the market goes down. But since the market didn't go down, the market actually started going up. What that implies to me is that while they might have still been rotating out of growth and out of tech, they were rotating into other areas of the market. In other words, they weren't leaving the market. They were going into other areas because the market actually went up.
Okay, that makes sense.
But now what's happened is we came down here and looks like we're trying to make a higher low, but that is not actually a higher low until we can make a higher high. Right. So we've got to get above this 4,100 area that I talked about on the last session.
Yeah, 4,100 has been a very important mark you've referenced for a month now. So
yeah, it's really important. And actually the 200-day moving average has been really key, because you can see it hit it here.
Oh yeah.
Went a little above it there, hit it there, hit it there, hit it there, hit it there. The 200-day is coming down lower too. So it's down now at around 4,000. It's actually a little below 4,000, 39.68.
Okay.
So the market, interestingly, ended at 39.72. So 4 points above that 200-day moving average on Friday.
Right.
But this rotation here between discretionary and staples, between technology, between growth and value, is starting to climb back up again.
Yeah.
Right? It's starting to.
It is. Yeah.
That's the purpose of looking at things like this, is you want to see what's happening underneath the market. You don't want to just go by, the market is going down and I have a feeling it's going to keep going down. And I think we're going to crash and there's another big crash ahead. And you see that. I don't know if people get newsletters and stuff like that. All these newsletters are saying the big crash is coming.
Yeah. Well, welcome to YouTube. If you say crash in the title, you get more clicks.
Right, exactly. But this would imply that might not be the case. So let's take a look at some of these sectors.
Okay.
First, we'll look at the discretionary versus staples. So discretionary are things that you would like to buy, and staples are things that you have to buy.
Got it. Or
need to buy. So discretionary, the two biggest names in the discretionary is Amazon and Tesla. They make up about 34% of the discretionary.
Right.
And things in the XLP, consumer staples, are things like Procter and Gamble.
Right.
Soap, toothpaste, things like that. So this is an important one to watch, because if the XLI starts to outperform the XLP, which it is doing in 2023 so far, then that means the big institutions are rotating back into risk areas, back into growth. All right. So it's starting to look positive, but we need to see if that's going to continue. You can kind of see a little subtle change here in discretionary versus staples. Staples looks like it's going down more, and discretionary looks like it's going up more. All right. So we'll see. Now let's look at some of the other ones. I'm just going to start with materials, and I'm going to flip through these pretty quickly. And the important thing to look for is, first of all, this gray area up here. This is the weekly trend. So on a weekly basis, even though this is a daily chart down here, this gray area gives us a sense for what the weekly looks like. So materials are things like mining companies, aluminum, steel, things like that.
Okay.
They've been doing really well. In fact, you can see where it crossed and started climbing higher back here in October, and they've actually had a really nice run. So they look still pretty healthy. So that looks like a pretty good sector to be in. Next one is communication services. Now, this is the one to me that's really interesting.
Yeah, this is like Snap and Meta and like that.
Yeah. These are all the internet stocks. It's also newspapers, broadcasting companies, things like that. But internet in particular is one of the big areas in this particular sector. That's also Google, by the way. We're going to look at Google here in a second.
Okay.
This has been an awful, terrible, ridiculously, incredibly terrible. In fact, we'll look at a weekly view of communications. There's what it's looked like for the whole year. In fact, before that, even back in October, when it first started crashing, and I think that was when Meta made their big announcement right there and missed their earnings. But ever since then, all the way through this whole year, this sector, and internet in particular, has just been nothing but down. But it looks like it's trying to make a little recovery right here. Now, remember, this is a weekly chart.
Yeah.
So if I go back and look at it on the daily chart, you can see here it's starting to get above its moving averages. It's not quite above the 200-day yet, but it's starting to move up. Now, interestingly, historically, internet stocks do the best in January.
Oh, really? I didn't know that.
Their best month of the year. So it might be a good time to look at Google and Meta and some of those.
Yeah. Well, I'm glad I bought Meta when I did, so that's cool.
Yeah. And the weekly looks really good too. So next one is energy. Energy, as everyone knows, has been really good. It had a little decline right here in November. starting to climb back up again. The weekly looks pretty good. This is the individual. So this one up here is compared to the S&P. So is it outperforming the S&P or underperforming? And then this one down here is the actual sector itself. So energy still looks good, still heading higher. Financials is starting to roll over.
Yeah.
So that might be a problem with financials. Industrials was also a really good one. And it now is looking really bad.
Yeah, it just
industrials
broke.
falling over. And look at the weekly over here. Industrials is definitely looking bad. So this is like Caterpillar and companies like that.
Sense. Oh my gosh, a recession. Who knew? Nobody's buying capital equipment.
Here's technology. Take a look at this.
Oh, look at you. Tech just did the other thing, went up.
Technology is starting to recover. The weekly is looking better. Technology itself is still sort of moving sideways along the bottom, but it's starting to show a little sign of life right there.
Okay.
We're going to look at the technology big cap stocks here in a minute. Here's consumer staples. Remember, those are the ones that do best during downturns. Staples should do well in a recession.
Yeah.
They might not necessarily beat. I mean, they still might go down, those stocks. But in relation to the S&P, that's where big institutions typically move their money to going into a recession, because you're still going to buy soap and toothpaste and toilet paper and all that stuff.
That's interesting, how far down. Okay. That's interesting.
Yeah, exactly. And this is, remember, this is relative to the S&P.
Right.
So is it underperforming or outperforming the S&P? And if big institutions, if their charter is to outperform the main index, and we're going to a recession, you would think that they would want to be in these names.
Right.
But they're not. And the sector itself is actually going much lower. Real estate. There you go. Real estate is kind of trending slowly higher.
Yeah. Grinding higher. Yeah.
Grinding higher. Yeah, it's a good way to put it. Grinding higher. Utilities for a while were doing really well, especially when there was talk of recessions, starting in December. But now they have rolled over. And the weekly up here is below 0 too. So again, utilities is a defensive sector.
Right.
That's one of the sectors that big institutions will move to heading into a recession. Healthcare. Uh-oh, don't crash on me, please.
Oh, there it is.
Healthcare's rolled over.
Yep.
Again, that's usually something that, people are still gonna need healthcare in a recession.
Yep.
Healthcare is rolled over. So that one doesn't look too good. Here's consumer discretionary. That one's starting to roll back up. Isn't quite out of the woods yet, I don't think. But it's beginning to show some signs of life. And you can see on the weekly up here, it's not above 0 yet, but it's headed that way. And then this is the XLY versus XLP that we looked at before.
Okay.
So from looking at all those sectors, my takeaway from that is it looks like the market might be wanting to go back into risk on mode.
Which will be very interesting with an inflation report in about 3 weeks.
That will be very interesting with that inflation report. I mean, yeah, that could be a real head fake if inflation comes in hotter, and all of this will then fall apart, because
it'll fall apart in an instant that morning.
Oh yeah, no question. Immediately. Yeah. All right, so let's look at some of the big tech names, and this is one that I put in my newsletter because they reported last week. Netflix.
Yeah. Yep.
And there's something called a Darvis box theory. Nicholas Darvis was a ballroom dancer back in the 50s, and he was in a little nightclub in Toronto, and the guy couldn't pay him, so he gave him stock certificates instead. And he was a ballroom dancer. He had no idea what stocks were. So he was kind of pissed off, threw them in a drawer, pulled them out 3 months later, and they'd gone up by 10 times. And he's like, oh my God, how come I didn't know about this? So he started studying the stock market as he was traveling around the world with his dance routine, studying the stock market, getting Barron's magazine a week late. And he started noticing something about stocks that did well is that they would go up and they would go sideways for a while.
Yep.
And then after going sideways, it would break through the top and they would go higher, and then they would stop and just go sideways. And then at some point they would break through the top again and go sideways. So he said, well, I'm just going to watch them because I can't watch it every day. It's the 50s. There's no internet, right? I get Barron's a week late, but I can at least see what the prices were. And I can see what box it's in. So he started giving the boxes a high and a low. And he would just look to see if any of the stocks he was following would break out of the top of the box. And as soon as it did, he would buy it. So this is Netflix. Netflix is a perfect example of a Darvas box theory. So you can see after a drop down here, went sideways for what? 1, 2, 3 months.
Yeah.
And then it broke out. And this was probably earnings. I'm not sure what it was right here, but it broke out above the box. So that would be his buy. He would have bought it at 216, and they would put a stop in wherever he determined the bottom of the box was. So the stop would be at 200 in this case. And then he would just let it ride. He would just watch it. Now you can see 1, 2, 3 more months went by. And then suddenly it broke out of the top of the box again. So he would have bought more right here. He would have bought more at 272. Now he's still in this buy at 216. Right. He would have bought more at 272 and put his stop in at 252, the bottom of the box down here. Okay. All right. As long as it didn't violate the bottom of the box, he just stayed in it and just let it ride. So it just went up. He didn't buy any more, but he just watched it until last week. It broke out of the top of the box. Now, interestingly, the top of this box, which makes the bottom of this third box here, happens to be the bottom of this big gap down that happened back in April. And I drew 2 lines on these. There's the gap down, and this is where it was before it gapped. When it broke out of this last week on earnings, it also broke out of this gap right here. All right, so that's where he would have bought it again. He would have bought it, put another purchase in at 342, and then identified where the box was. It started stop at 300, but he would just watch it probably for 3 more months. So this was 1, 2, 3. So every 3 months, looks like he would just watch it again. And that's what he did. He did in 18 months. He made $2 million just by using this process.
Well, that does. And back when $2 million was real 2 million.
It would have been 20 million. I checked into it. 2 million would have been 20 million today.
Interesting. Okay. I like it.
So that was his box theory. Pretty simple. Just buy it when it breaks out and just hold it. Wait, see if it breaks out again. And if it doesn't, if it breaks down, get out. Get out.
Yeah, you got your stops. That's the key. Stops.
So that's Netflix. So let's take a look at the other ones and see what they look like right now. Here's Google. Remember I said the internet stocks, January is their best month, usually. So Google had a really nice run on Friday. It's now above its 21, above its 50, and above its 89. The 200 is right up here at this resistance level.
Okay.
But it looks to me like it wants to break out up there as well. And if I drew a trend line right across these tops, you can see it just broke out of that too.
Okay.
I can draw it all the way back there. So just broke out of that trend line as well. Google might be headed higher.
Okay.
Amazon. There's Amazon. Amazon is hanging around its bottom. So Amazon bottomed here at about 80. But it had a nice little candle on Friday as well. Came down to almost to its 21-day moving average, reversion to the mean. And it looks like it's trying to trend higher. So there's the resistance right there at about 105, 104. So we'll see what happens with that one. Here's Apple. Apple has been all over the place. And there's no clear trend yet for Apple. Actually, let me go back and Netflix, pay attention to the volume right down here just for a second. Just I'm going to flip through these quickly, but just watch the volume down there.
Sure.
There's Netflix. There's Google. Amazon doesn't have too much. Apple has nice volume. Right?
Yep.
So it's starting to come back. Meta, here's Meta. Meta's about average volume, but it's trying to make a run as well.
Yeah, I'm really glad I bought it in early November.
Yeah, right back here. Yeah, no kidding. It's a great buy. I mean, this January is the best month for these stocks. So if it gets above its 200-day right here at 150, and the market cooperates and inflation cooperates,
right?
I expect it to go sideways right in this area right here.
Sure. Yep.
Right. And it's hard to see where the box is, but it's probably right across the top of these highs right here. Right. So it's probably right at it, right at that 140 level.
Okay.
And then the last one is Microsoft. Microsoft, again, doesn't really have a clear pattern, except that it's trying to get above all of its moving averages right down here. Again, the 200-day has been resistance throughout the whole year for Microsoft as well.
Yeah. Well, do me a favor. Can you throw in BX there, Blackstone? It's one of the company's dividend stocks I bought.
Sure.
Oh, I thought you could have just changed
BX?
it. BX. Yeah. Yeah. There you go.
There's BX. Again, it's had a nice candle on Friday. It touched its 21-day. It's bouncing off of it. It's above its 50 and trying to get above the 89.
Very cool.
The 200-day is at 95.
Perfect.
So it might be trying to make a run. And then JPM, we'll look at that too.
Yeah, why not?
JPM has actually been coming down. Now, remember when I looked at the sectors and the financials looked like they were rolling over?
Right.
Remember that? So
I do. Yeah.
JPM is in that one. This one might trade down to the 50-day down here.
Yeah. Okay. Well, I only got one tranche at 104, so I'm looking for an entry point for another tranche of JP Morgan.
So there's two ways you could do it. You either could make an entry point at the 50,
okay,
which is about 130.
Okay.
But you can put an order in right there at the 130. Or if you wanted to try a Darvis box thing, let's see if I can do this. It would be right about like that.
Oh, okay.
So there's the box. So you could do another tranche at 130, small one, and then buy it again if it breaks out above 145.
Okay. Yeah, for me, I think something I've uncovered with this conversation, I hadn't yet thought about it, is that inflation number in the middle of February.
Right.
I think could change a lot of things.
It could give all of these a good entry point. Now, I don't think, based on everything that I've looked at, I don't think the market is going to go to new lows. I think even if we do get a bad inflation number, we may go back and test this one down here. We might test 38. Okay. Or we might go down and test 35 again.
Yeah.
But I don't think we're going lower. I don't think we're going to make a lower low. And I still think that we're going to get up above 4,100 and take out those stops up here.
Yeah, this is why I love having you on the show, because charts are not my thing by any stretch. I look at the macro environment. I look at the earnings environment. I look at what now, because of this conversation, could be a negative surprise on inflation. And I certainly don't feel good about that bottom.
Right. Yeah, it doesn't look good. I mean, we'll see what happens in the next couple of weeks. Right. So now when I do this little video on my own, I send it to you, right? Will you load it up?
Actually, well, we'll talk about that off air. So do me a favor, show your newsletter one more time.
Sure. breakpointtrading@gmail.com. Just send me an email and I'll add you to the list. Just interestingly, by the way, Darvis's book is in the end of my newsletter. There's a list of books down there, and his book is down there. And one of the stories he told when he was dancing in Saigon, this shipping magnate, American shipping magnate, came up to him and he said, "Oh, so you're doing stocks," and he was kind of making fun of him.
Hmm.
He goes, "So what do you recommend?" And he said, I'm in two of them. I'm in, can't remember the two he was in, but one of them was one that Darvis was in too.
Hmm.
The guy said, "I've got 2.5 million in one, and I've got 500,000 in the other one. What do you think I should do?" Darvis said, "Well, based on the charts I've been looking at, you should get rid of the one you have 2.5 million in and put all that money in the other one."
Hmm.
And the guy started laughing at him. He goes, all of the analysts say that one is at its peak, that we should be shorting it, and it's about to go down. A year later, Darvis ran into that guy, and the guy said, "Hey, do you have any more advice for me?" He goes, "Well, I gave you $3 million worth of advice. What more do you
Yeah.
want?" The guy goes, "Yeah, it would have been great if I had taken it."
Oh,
He didn't. He didn't take it. The one that Darvis
ouch.
told him to go into,
Yeah.
tripled in price. The one that he was in crashed.
Yeah, there you go.
And that was just by looking at the charts.
Yeah. Very cool. Well, folks, do yourself a favor. It's a newsletter that I get each week, breakpointtrading@gmail.com. Dan, thank you so much.
You bet. Have a great trip to